Casey Mushrush, Sharon asks you, I inherited an IRA from my aunt last year. I'm worried that withdrawals could push me into a higher tax bracket. What is the smartest way for me to take the money out over time?
Sharon, this is a great question, something that we see not infrequently. So when people pass away and they still have money in an IRA and they leave it to someone, there are, the next question, of course, is, what do I do now? So there are a couple of things that we want to make sure that we take a look at. This really is going to depend on what your current age is, when you plan to retire, and what your overall income strategy really looks like. The timing is going to have a large impact on that ultimate tax strategy, and doing the planning ahead of time really makes all the difference. So just a couple of things we have to keep in mind here. This is a non-spouse beneficiary, meaning that with a few exceptions, you're going to be following something called the 10-year rule. Now, essentially what that means is by the end of year 10, so as an example, we're here in 2025, in 2035, that account needs to be spent down to zero. There needs to be $0 left at the end of that account. So there is a 10-year rule that it must be distributed within the 10-year time frame following the original owner's death. Now, depending on the relationship to the decedent, you might also have an annual required minimum distribution requirement that you have to pull out each year. So RMDs might actually impact you if they would have impacted the original owner. So you would have to pull out a minimal amount every single year over that 10-year time frame. Now, the big answer to your question really is about managing the timing on those withdrawals. Now, if you're still working, maybe it's looking at, and you're relatively young, maybe it's an equalization strategy. And what I mean by that is in year 1, you take 1/10 of the account. In year 2, you take 1/9 of the account. In year 3, you take 1/8, and so on until you pull the entire account value out at the end of that time frame. That would be roughly approximately the same dollars pulled out of that account each year, and that smooths that overall tax ride for you over that time frame. You have a lot of predictability in terms of those distributions. Another option, if you're a little bit closer to retirement, let's say that you inherited this account when you were 58 years old and you were planning on retiring at 64 or 66, you could pull out the minimum amounts if you have that requirement and then utilize this account to front load your retirement distributions. So rather than pulling out of your own retirement accounts, use the inherited funds in order to fund those lifestyle expenses for the first year or 2 or 3, depends on the amount of dollars that you would actually be receiving. Now, if you're self-employed, there is another strategy that is maybe a little bit more sophisticated, or if you have variable income, you could also possibly offset some of those taxable distributions coming from an inherited pre-tax traditional IRA by increasing your pre-tax contributions over into your other retirement accounts. Now, what I mean by this, let's say, for example, you are a sole proprietor or you have a sole member LLC, something that is generating Schedule C income, so you're a contractor of some sort. You could set up your own retirement plan, and if under this equalization strategy, you were going to be pulling approximately $10,000 out every single year, you could pull out the $10,000 out of the inherited IRA. That creates taxable income. And then if you have the income somewhere else, you can contribute it back into a SEP IRA, a simple IRA, a solo 401k plan in order to essentially do a tax exchange at that point. So I've generated $10,000 of additional income, and then I've made a contribution, and I've gotten a $10,000 deduction. Well, in terms of net tax, the total on that is zero. My $10,000 offsets my $10,000. So really in a situation like that, we're simply shifting that from the pre-tax beneficiary account over into a pre-tax account underneath your own Social Security number where you have maybe more time to grow those assets as well.
Sure, this can get complicated. It's a great question to ask, and it's a great question to ask professionals like the professionals at Premier Investments and Wealth Management. They deal with this on a regular basis. It's good that you got in touch with them. PremierIWM.com is the website. While you're there, you can find all sorts of really neat stuff. The Premier Investments Investors Guide Series, all sorts of information for all sorts of markets, all sorts of situations in life that find you where you are. personally. Maybe you're in your 40s. Maybe you have retirement's just 5-10 years down the road. Maybe you're making that embarkment into retirement right now. Get in touch with them at Premier Investments in Wealth Management, premieriwm.com. 800-383-6590. Premier Investments in Wealth Management named to Forbes 2025 Best in State Wealth Management Teams.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs and does not assure a profit or protect against loss. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Forbes' Best in State Wealth Management Teams ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firm. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.